Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. When you invest in real estate, work with the experts at Building Insurance and Risk. You will receive multiple coverage offers with a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Stuart Keller. Stuart is currently the head of Investor Relations Syndication Division, focused on senior living communities throughout the U.S. In just a minute, we're going to speak with Stuart about senior housing. But first, there are a couple things you can do to help us out. If you like our show, you can like, share, and subscribe to CREPN Radio. And also, if you'd like to see how handsome our guests are, be sure to go to our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Stuart Keller. Welcome to CREPN Radio.
Thank you so much for having me. Really looking forward to catching up with you on all things senior housing.
Well, I'm looking forward to myself. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, so just kind of high level. I've had a very unique blend of both asset management, financial analysis, operations, and as of about 3 months ago, stepped into the investor relations space. Right after grad school, got a job as, absolutely greener than green asset manager, doing acquisitions, asset management, dispositions. This was in 2010. So we were buying a lot of stuff, REO, foreclosures from different banks. We were reviewing their bank tapes. Did that for a few years, moved over to operations, overseeing some multifamily properties as a regional manager and then as a regional vice president. Then about 3.5 years ago, took over the asset management division here at Lloyd Jones, successfully built that, led the acquisition, and then in 2022, the disposition on a little bit more than $800 million in assets. And now I'm in the process of building out our syndication platform, which is actually going to allow accredited investors to own a piece of a senior living community. In the United States, we've definitely taken a bull position with respect to senior living communities, especially where the demographics are changing within the United States with kind of what they call the silver tsunami of baby boomers.
Got it. So let me ask you, I guess the first thing that comes to mind is, how do you define senior housing?
So senior housing is going to be really broken down into 4 facets. The first is age-restricted communities, just anybody, 55 or older. It's going to be a lot of activities for the residents, very similar in terms of underwriting to multifamily. But the 55 plus, you're going to see an average resident stay of 7 years versus 1 or 2 years in a multifamily. From there, you move up into what they call independent living, which is 55 plus, but you're going to have more enhanced amenities such as a salon, a barber, more regular activities and actual classes. And you're also going to get 3 to 4 meals a day. And those properties typically come with a full commercial kitchen. The next level of care is going to be your assisted living, which is your independent living with a medical component to it, where they will be actually giving the residents medicines, being able to take them to and from the hospital for their appointments. And then the next kind of step is memory care, which is typically going to be on the same kind of property or community as an assisted living, but it's going to have its own wing with much higher level of skilled care, nursing, director of health, director of wellness. So there's going to be definite higher rents, but you're also going to have a higher operating expense. So your operating margin is actually going to increase as you increase within the levels of care.
Got it. So one of the curiosities I have is that typically when I think of real estate and like the syndication model, if you get a group of investors to acquire an individual property, the operations are fairly straightforward, and is that it's a management issue, and it could be third party. You could outsource that, or if you have your own in-house management, you could manage that. But the management is more about just keeping the property full, keeping it maintained, maybe renovating if that's part of your plan.
Mm-hmm.
And it sounds like in that senior housing, the first option you gave there, the 55 plus, kind of the age restricted community, that may be more of kind of the similar model like you mentioned in multifamily. As you get into the more involved levels, like you have the independent living, assisted and memory care, obviously memory care at the top there, but how is it just a function of the fact that as the care level increases, so do the receipts and so do the expenses, or are you operating these or do you purchase the property in one entity and then have an operator as a second entity that's actually providing the care and all the day-to-day with the residents?
Yeah, so great question. So just kind of starting with your last point there. So typically to kind of mitigate risk, these properties are purchased under what they call an operating company and a property company. The property company is going to have your licenses. It's going to carry heavier insurance, whereas the operating company is actually going to be the building, the site, the assets. And there's typically going to be a lease agreement between the opco and the propco. Now, taking it a step further, the level of kind of granularity and difficult nature of managing a senior living property generally increases pretty substantially as you increase in levels of care. Now, to kind of add something else to that, each state is going to have its own regulations and its own staffing requirements. So, and this is just completely hypothetical. I didn't memorize the statistics, but, within, let's say Florida, for every one independent living resident, you might need, 0.25 caregivers or something. So as you increase the number of residents, you're going to have to increase the number of maybe nurses. For assisted living, maybe for every 5 residents, you need 1 more skilled nurse. So each of the states is going to have its own requirements. And we've actually, here at Lloyd Jones in 2019, we started our own operations side of the company called Aviva Senior Living, where we've actually hired within the 4 different regions a COO and a CIO to oversee all of the assets within their region. So they're going to become market experts, be able to closely oversee the day-to-day operations of these properties, and make sure that we're in compliance with both state and federal regulations. But from a staffing standpoint, staffing is probably one of the key metrics and benchmarks that you're going to evaluate when you want to invest in a senior living community.
Oh, got it. And the demand, you mentioned the silver tsunami. Is that just a pure function of just as the population ages, more people are going to need the care, or are there specific areas that you recognize the numbers to be more significant? Can you
Absolutely. Yeah. So starting in 2019, 10,000 baby boomers started turning 65 every day. Now, that was the leading edge. In 2022, those same baby boomers started turning 75. So if you were to say, okay, those age 75 or older, 20% of those individuals either want or need to live in a senior living community by 2030, there's going to be anywhere from a 1 million to 1.5 million unit shortfall within the United States. Now, you might say, okay, well, that's really interesting, but isn't there a lot of development going on? Currently, there's anywhere from 40 to 50,000 units being delivered each year. That million to 1.5 million unit shortfall number already takes that into account. So there is going to be a either huge supply shortfall or a significant demand surplus, which is going to drive the demand for senior living communities. The development that is going on here within the United States, a majority of the development is taking place in the 5 major Sunbelt markets. Although what those developers are not taking into account is that 70 to 80% of seniors will actually move back to their hometown to actually, live in a senior living community. So they might spend, 10 years living in Florida, enjoying the beaches. But when it comes time for them to transition to an independent living or assisted living community, they're going to go back home. Now, even if that back home means a smaller town in Indiana, where we actually purchased a property in Valparaiso, Indiana, just looking at that small cohort of demographics, there's 5 communities there. There's nothing in the pipeline. And as of today, there's anywhere from a 80 to 200 unit shortfall of available senior housing based on the existing demand. So that's kind of the forward-looking demand curve that we've identified. And we're taking very much a philanthropic private equity approach to our investment strategy, understanding that the developers are going to be targeting the top 10 or 20% of earners in the country. The middle market, that 60%, is being largely ignored. And that's what we're aiming to do, whether it's through acquiring senior living properties, doing a light renovation, and still maintaining its affordability based on the income demographics, or actually going through and doing hotel conversions, typically, mid-rise, single building, extended stays that have a little kitchen already in them, and converting those into independent living communities.
Now that makes sense from a feasibility, or I mean, just the bones are there for like a hotel conversion kind of thing. That makes sense.
Yeah.
It's interesting, the statistics there about the 70 to 80% will return to where they're from. And I guess it makes sense. I hadn't really thought of it that much, but are you, when you say home, is it where they're from, or is it where they have family, or are those considered to be the same?
Typically both. Now, if a family, for example, my wife and I, we live in Northeast Florida. When it comes time for her father, if and when he needs to live in an independent living or assisted living community, he would move up here. Now, we're not from here. She's from New Jersey, but it's mainly where the main cohort of the family is located. But typically what we've seen, especially in Valparaiso, Indiana, population is 35,000. We're actually seeing an 11% net immigration of those 75 or older. So, those seniors are coming home to kind of where their roots are.
So from an identifying, when you set out to try and identify a market, you're not looking for job growth per se. How do you identify a market that has that inward migration of the silver tsunami?
So we're actually kind of taking a kind of full, well-rounded approach to the underwriting. we are looking at, average equity in home values. Seniors will typically leverage the existing equity in their homes to be able to pay for or, fund their new home. We're also looking at the average income of the children and family members of the potential residents. Typically in senior living, we're not marketing to the future resident. We're going to be marketing to them as well as their family members. So it's very much a family decision, whereas in apartments, it's more of a one-on-one transaction with the resident. And then I think most importantly, we do utilize a system called Vision LTC, which is a paid service that will actually break down not only the demographics, but actually the demand surplus in each of the different age cohorts that you can filter out, whether you want to see number of potential residents, over the age 65 with net worths of X, or their kids' net worth or average incomes of Y. So you're able to kind of take a full faceted approach to understanding what good investment opportunities are, and then be able to back in to your pricing and your underwriting and your business plan development to make it a successful investment.
Got it. As for the numbers, I know like in, multifamily per se, typically you underwrite to a 50% NOI. I mean, just as a back of the napkin kind of thing. Obviously, you want to try and do better than that if you can. Is that a similar, or is there a benchmark for underwriting for net operating income based on income and operating expenses?
Yeah, so senior living is heavily focused on operating margins. Their occupancy is typically geared towards what they would call a census as opposed to occupancy. Now, some of those rooms or units will actually be able to house 2 residents. So there's going to be a second person fee, maybe in a 1-bedroom or a 2-bedroom unit. So pricing is going to, fluctuate a little bit differently. But as far as the kind of benchmarks relative to multifamily, I would be lying to you if I knew what those, key operating margins were, because it's going to vary not only by asset class, asset size, but then also the ratio of IL, AL, and memory care units. So it's going to be a kind of 3 or 4 pronged approach to what a good operating margin is. If you have a property that's 10 independent living, 20 assisted living, and 5 memory care, you're going to have to mold all those together into what a effective operating margin is. Whereas if you had, a deal that we have on Crowd Street right now, it's 88 assisted living and 24 memory care. So that's going to have its own set of benchmarks from there.
Got it. So you mentioned a couple of different size of properties there, just in the examples you were talking about. Is there a sweet spot for you guys, or is there a minimum size of an asset that you are developing or acquiring?
Yeah. So typically, I mean, our recent acquisitions, we've closed on 14 so far in 2022. Really, the average asset size is anywhere from 80 units up to 130 to 140. The number of staff is going to grow pretty substantially. Now, typically in multifamily, you would have a 1/100 ratio. In independent living, or I guess moreover assisted living, for a 80 unit property, you might have 20 or 25 staff members on that property, and that'll grow. So the sweet spot, the nexus between your staffing ratio requirements and your occupancy, is really something that you would need to optimize. Getting that one extra resident might mean that you have to hire a whole nother full-time person, and your net operating margin would actually go down.
Right. And you said that those numbers are governed by the state regs. Is that
Yes, sir.
right?
That's
Based on the
correct.
level of care?
Yeah.
Got it. So, uh, you mentioned some hotel conversions. Is there a specific strategy you guys have in acquiring properties? Are you developing any new? Is it primarily by existing and rehab, or is it just by operating assets and make them work better? Or?
Yes. So, right now we are looking at hotels, typically single building, mid rise. They typically, or kind of what we like to see is that they already have a little kitchenette, so they have the plumbing available for an independent living community. Elevated is an absolute must. We are also looking at, we're actually doing several ground up developments. COVID, supply chain issues, and inflation in the debt markets have all taken a, center stage in kind of changing how effective it is to do ground up development right now.
Yeah, that's a little hard to get a real solid plan when everything's changing. So I
Yeah,
get it.
absolutely.
So, investors, what's the interest been like for investors when you're raising capital?
So the biggest thing, the light bulb really goes on when I compare where we are in senior living today is where multifamily was 12 years ago. You know, multifamily 12 years ago, you could see the, Gen X, the Gen Y, and the Gen Z all needing to move out of their parents' homes and into college. Those then move into apartments. We all saw it coming, but we never addressed the housing shortfall. Now, rental rates, I mean, it's making the news every day. Rental rates are going up anywhere from, I think in last year was 30 or 35%. It was absolutely insane. So from that standpoint, definitely as far as a investor interaction, it's a combination of providing additional education for them. But then on the investment return side, what really piques their interest is we're buying these properties in, high single digit cap rates. Yields on these deals are typically, anywhere from a 7% on the low end to an 11% on the high end. So, COVID, as horrific as it was for our aging population, the occupancies dropped pretty substantially from 2019 to 2022. A lot of these REITs and major institutions have actually elected to exit as opposed to continuing throughout the life cycle of owning the asset. So we're actually buying these properties at a deep discount. So that's what's really driving our big push, explaining to the investor the business plan. And we're actually getting a lot of favorable feedback and interest, especially on the deal that we have on Crowd Street. I think it was 2 million raised in the first 5 days. So from that standpoint, and that's minimum investment of 25,000. So the more education, the more people learn about the future of senior living, the more impactful it'll be, and the more widespread it will become as a choice investment for people with the disposable income to be able to invest.
As far as strategy goes, you're acquiring, operating. What's the expected hold time on these? I know with like syndications, there's usually an advertised exit. What's your typical hold time?
So based on the investment, we have a couple that are just absolute, true opportunistic plays. Typically 3 years will be on an opportunistic. We'll buy it all cash. We'll stabilize it, and then we'll recapitalize it, whether we put it onto a syndication platform or whether we bring in an outside JV. For our syndicated deals right now, we're underwriting to a 5-year hold. And typically how we underwrite to make a deal, see if it's truly a good investment, is to be as conservative as possible and still get north of a 7.5 to 8% yield and a 20% deal level IRR, which typically will result in a 17 net IRR to the investor.
No, that's always impressive when you can reach those kind of numbers. You mentioned what was it, 20 or 12? I can't remember how many assets you acquired this year.
14.
14. How many have you been doing this long enough to have some assets that have gone full cycle?
Not as of yet. So we have some assets. I mean, one's under contract right now. When we started underwriting it, it was at 70, 75, 76% occupancy. We're closing on it in November of this year. Property's already at 88% occupancy, just based on the current domestic demand of that market. And prior to us even taking over, we're already seeing surpassed performance relative to our year one underwriting, which is fantastic. This year I did take 12 assets through the disposition process. They had all kind of reached their 5-year benchmark. So I went through, led the disposition efforts on those. Average realized net IRR to our investment partners was a 48 with more than a 3x equity multiple. So I mean, it was we definitely take a conservative approach to underwriting, but no, we have not taken one of these senior deals full life cycle as of yet.
Got it. So far, investors are pleased. It sounds like any lack of interest. I mean, would you say 2 million in 5 days? That's pretty good.
Yeah. I mean, as far as the interest, it's more over, typically these deals are going to have smaller equity checks, maybe up to 10 or 12 million. Some of the larger institutional investors, they need minimum equity checks of 50 million. So there's being able to package these in the future into portfolios, I think is going to be very attractive.
Yeah. That's all good stuff there. If you had to identify, is there one challenge that in the time you've been doing this, that is one of the larger challenge, or for just across the board, is there a challenge, or is it all just good stuff?
I would say the biggest challenge that we've had to kind of circle up is going to be on-site staffing. I mean, labor markets throughout the US are a challenge. So being able to develop kind of what we're calling transition teams to be able to go in and fill the gaps of the on-site staff is crucial. That's probably been the single largest challenge. Second to the rapidly rising costs of construction and interior renovation companies relative to underwriting. So being able to figure out what truly the residents need or want versus what we had planned. Maybe they don't really care about, changing out the backsplash in their little kitchenette. They would rather have a washer and dryer put in their unit.
Yeah, no, definitely finding those things that people want as opposed to those that they don't really care about is definitely that's got a key to marketing. Make sure you get that right. But yeah. I get it. Hey, Stuart, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, then we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be clients, investors, interest rates, inflation, tenants, whatever, however you can take a look at your situation and identify what you consider to be the biggest risk. And for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Stuart Keller, what is the biggest risk?
I would say, I think what we all experienced collectively as a nation in 2020 and 2021 was, a pandemic that disproportionately impacted the senior population. The impact to you and I was a lack of availability to get a haircut. Some small mom and pop, a lot of small stores and, mom and pop businesses went out of business. For the senior living population, there was COVID restrictions, not allowing new move-ins into the communities. Just a significant impact, which hurt both occupancy, which drove down the net cash flow, but also the ability for new residents to want to move outside of their homes where they felt, safe and secure. So I would say definitely, if there was a repeat, hope to God there isn't, of 2020, I would say that's probably the single biggest risk factor in senior living.
No, I hope we don't go there again. I know that as we record, there's another surge of whatever the latest variant is, but it seems like how to manage it. I mean, we're a little bit more capable of managing. Just hopefully it doesn't, or a new one doesn't come out and repeat. So
yeah,
I'm with you there. Hey, Stuart, where can the listeners go if they'd like to learn more or connect with you?
Yeah, so we have on our website, LloydJonesLLC.com. That's LLOYDJONES LLC.com. Or if you'd like to get in touch with me directly, if you visit LloydJonesInvestments.com, you're able to go in, get in touch with a member of our investor relations team, or you can simply email invest@LloydJonesLLC.com, and that will be forwarded to me, where we can actually use my calendar link and schedule a one-on-one call to catch up.
Awesome. Well, Stuart, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Absolutely. Thank you very much for having me, Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.